I'm here to tell you about taking a short position in Intel, or at least recommending a sell if you already have a position. Over the past year, shares of Intel has fallen over more than 20% as the market worries about its ability to survive in an increasingly mobile world. The big concern here is that we are transitioning from traditional PC system to cloud computing to tablet to smartphones, and Intel doesn't have a dominant position right now. So the investors are worried whether Intel can survive. Now, a recent data released by NASDAQ for March 28, 2013 settlement date indicated that Intel has almost 7 days to cover as compared to 3 days on average for all the Dow components. The days to cover is calculated by taking the number of shares that have been shorted as of that date compared divided by the daily average volume of trading. So if you divide this number by that, you get 6.73. The significance of this number tells us how many days it will take all short sellers to cover their position if they were to sell it. That means it will take more than 1 week trading days for them to do that. And it also gives us an indication of the direction of the stock price, both by fundamentalists and technical traders. If you have a days to cover ratio of 5 and above, it gives you an indication of a bearish sentiment in the market. That means investors don't expect the share price to go up. And as you can see, as of that date, Intel was the number 2 most shorted stock on the Dow company. This slide just talks about some of the competitors Intel have in the industry. First, we have advanced micro devices, and which is also confined to the PC industry. Is struggling because it's also in the PC industry, and we are moving from there. For the past year, its sales have dropped more than 70%. And then we have ARMS Holding, who has a dominant share in the smartphone market, together with Qualcomm. They are doing well presently because they are well positioned for the current trend in the market. And of course, we have Texas Instruments and Samsung Electronics. They also do produce some chips. And I have some of the trends and weaknesses that one might consider when trying to buy Intel, or why you should just stay away from Intel stock right now. We say it's highly confined to the PC segment, and it generates more than 64% of its total revenue from the PC segment. And as we move away from the PC to cloud computing to tablet, it will find itself in trouble in generating revenue in coming years. And then we say it's also lagging in the mobile platform, just as I said. And we also say its shells are very expensive. Its chips are very expensive compared to AMD. If you have laptops and ultrabooks that are powered by Intel chips, you see them, they sell at a premium. And that is also something that you have to consider. And it doesn't even have any presence in the smartphone market as of now. Some of the trends too now we see is the drop in PC sales. A research published by National Data Corporation on April 10th, about 2 weeks ago, indicated that PC shipment fell almost 14%. The drop started in the second quarter of 2012, and as of the first quarter of 2013, it has dropped more than 13%. And this just gives you an idea how investors reacted when the news came out. You see, we have Intel, we have Microsoft, we have HP, they're all in the PC market. So the news came when the market has closed, and this is how investors reacted. This just gives you an idea how how the news impacted on investors holding in the stock. And this just talks about the supply chain where Intel gets its money. It gets almost 18% of its revenue from HP, 14% from Dell, and 2.5% from Apple, because it only needs some chips to power 8 MacBooks. That is the only thing that business with Apple. And we see HP is struggling. For the past year, HP has been down more than 18%, almost 19%. And Dell is also thinking of going private. So it's been struggling for the past year. It has been down more than 17%. And of course, we know what is going on in Apple. It's been down more than 30% for the past year. And even Apple just announced price cuts on MacBooks. It tells you the PC business or the traditional business is not doing well. Now move on to the ratios, how the numbers tell the story. I'll start with the current ratio. The current ratio for Intel for the past 5 years has not been gathered, but I'll rely on the just the current 3 years or the past 3 years. You see there is a decreasing trend from 2022 and 2017, 2019. It's fine, it's not that bad, but we rather want a higher number. The current ratio tells us how much the company has to cover its current liabilities, like when payables are due within the short term, within 1 year. So rather want a higher number. So you can tie that down to the inventory turnover. If they don't generate more sales, if they don't sell more, it means they won't have a lot of money out there to pay their bills on their deal. If you compare that one to its competitors like Qualcomm, it has a better, it has an increasing trend of current ratio. That is what we want. See, it's been increasing steadily. That is what we want. And then the next one will be the return on equity. If you compare the return on equity, the trend in Intel, you will see that it's been decreasing. And so you have to be careful when there is a decreasing trend. It tells us how much money they are making for investors, how much money they are giving their investors. And if you compare that one to the S&P 500 for the past year, it means the S&P has returned. Somebody who invested in the S&P 500 index has gotten more money or more returns than somebody who did invest in Intel. And you can actually see it from here. Like, while for the past year, while Intel was going down, we have the S&P 500 actually going up. And so far it's returned like negative 14%, and while the S&P 500 has given 15%. And then we have the profit margin. The profit margin just tells us how profitable the company is. Like, especially if you have an increasing trend or you have a more profit margin, it means the company generating more sales and at the same time it's able to control its expenses, that it has a better handling of its expenses. And Intel has not been able to do a good job for the past 3 years. See, the trend has been going down, and it needs to take care of that. So it's actually stated in its recent report earnings that it's actually cutting capital spending from 13 billion to 12 billion plus or minus 500 million, because you cannot let the expenses just go like that. And then we have the next ratio as the PE ratio. The PE ratio for Intel is been decreasing for the past 5 years. See, it's just decreasing like that. And if you compare the PE ratio to that of the S&P 500, the PE ratio for the S&P 500 has been going up. And while this may not be necessarily bad, it just gives you a sentiment in the market that investors don't expect much earnings and they don't expect much growth, so they start bringing the stock down. And if you use the PE ratio, the current PE ratio times the forward EPS consensus, I expect a target price of around $20.34 for next year. But when I just revised my research, these numbers keep changing every day. So even for next year, it's just going to be around 23.86 if you use a different PE ratio and EPS, the current consensus in the market. The next ratio I'll talk about will be return on asset. This is how much the company is generating in revenue per every dollar of asset invested. And we really want that to be a higher number, an increasing number. And as you can see, for Intel, it's been decreasing. It's been decreasing. Actually, it dropped almost 17% between 2011 and 2012. but the trend is different when you compare it to its competitors. Theirs have been increasing. So we really want to, like we see a return on asset for Qualcomm, it's been increasing. Okay, then the next ratio will be asset turnover. This just tells us how much, how efficient the company is using the asset of the company. I will say that with this ratio, Intel has done a good job compared to its competitors. Intel has done a good job, but they shouldn't relax, they shouldn't be overconfident, because if, as you see here, the current one, the current data I have 2012, between 2011 and 2012, there was a huge drop. There was a huge drop, even though they've been doing a good job. And I'm worried whether they are able to sell enough inventory. So I computed the inventory turnover. I suspected that the inventory turnover will be down because it's not been able to sell enough PC as we've seen in the market. People don't upgrade, and people are moving away from traditional PCs to cloud computers, so they don't need a whole lot of computer to do business. So the inventory turnover, as you can see here, it's been going down, and between 2011 and 2012 there was a drop by about 11%. If you compare that one to its competitor like Qualcomm, you see it has a higher and an increasing inventory turnover. And then I'll talk about the next ratio as price to book. The price to book ratio just gives a relative value of the stock, whether it's undervalued or overvalued. Usually a number 3 and less, the PB ratio of 3 or less gets a red flag from investors. It indicates a poor earning projection. And I'll talk about the time interest earned. This tells us how many times the company can cover its interest expenses, like if the interest that it has to pay, how many times it can cover on a pre-tax basis. And the numbers, this is significantly higher, but between 2011 and 2012, there was a huge drop of like 22%. We wouldn't like that, even though this tells us that the company has over 46 times the funds available to pay its interest whenever they are due. But we wouldn't have to be overconfident. Things can go wrong when we run into a bad economic time. And if you compare that one to its competitors, the time interest earned for its competitors, like Qualcomm, theirs has not been decreasing like that. Or even ARM's holding, theirs have not been decreasing like that. And then I just wanted to calculate also the 1 year return, of Intel stock compared to somebody who invested in the Dow or somebody who invested in the S&P 500. Over the past year, stock of Intel has returned negative 21%. As at the time I was preparing this slide, as of April 2012 and as of April 12, 2012 to current April 12, 2013, the return has been negative 21%. It's improved, but it's still not something that you can see it's done a better job. If, as you can see from the slide, see as the S&P 500 has returned more than 15%, now even though it's improved, it's negative 14% here. So on a whole, I would advise that if you have positions in Intel, as you know how we are transitioning from PC to cloud computing to tablet to smartphones, where Intel doesn't have a dominant share. That's why we see the investors getting worried and they are bringing down the stock. So if you have a huge position, I would advise you to sell, or you take a rather short position. Thank you.